In this section, we look at property taxes. And property taxes obviously are not sales tax, they're not income tax. Property tax is a tax paid based on the ownership of a property. So when you purchase a house, you're going to be charged a tax every year called property tax that you have to pay to city, state, all that kind of good stuff. And the tax, well, in Michigan, is on real property like lands and buildings. There's also a category called personal property, like machines and equipments and signs and furniture, things like that. And that's generally not taxed in property tax, again, in the state of Michigan. So real property is what usually is taxed. So if you own a house and it's completely empty, you're going to get taxed the same as if you own that house and filled it with all kinds of furniture and fancy objects. So real property, again, typically lands and buildings. Now, just like sales tax, just like income tax, property tax is variable. It's actually probably more highly variable than the sales tax or the federal income tax because federal income tax applies to everybody in the entire country uh, equally, and sales tax usually applies to everybody in the state. There are municipalities and sales tax where you have a little bit of extra sales tax, but property tax can be variable based on what municipality you live in. And so the property tax that I pay on my house, it could be quite different than the property tax that somebody in the next town over pays on their house. Now, regardless of where or how much you live, usually property is assessed and those taxes are computed on the taxable value of your property. So they look at your house and they say, well, your house is worth $200,000. So your taxable value is going to be, well, let's make it easy. Let's say it's $200,000. And then they charge you something called a millage rate. A millage rate is the tax rate a property owner pays per 100,000, not 100, per $1,000 worth of taxable value. All right. And by the way, when you go to vote on property taxes, and you'll see there's a lot of different property tax proposals, it's almost always the vote is done based on a millage rate. So that is the tax rate per 100,000, not I keep saying 100,000, per $1,000 worth of taxable value. Now, I'm not going to get into taxable value too specific. Sometimes the taxable value is not exactly what the actual value of your house is, but that's a little over what this video is going to cover. So here's how you can figure out property taxes based on a millage rate. So property taxes are calculated using the following formula. Takes the taxable value, divide it by $1,000, and then multiply times the millage rate. That's going to be what they call your tax levy, or the amount of taxes you need to pay. All right. By the way, I got this formula from mountpleasant.org. That's where Mid-Michigan College is. So we're going to do an example. Assume the taxable value on your home is $145,000, and then there's total millage rate of 30.85. What would you pay in property taxes? Well, essentially, take a look at this. You're going to take your taxable value, 145,000. You're going to divide that. Actually, let me do something else here. Take 145,000. You're going to divide that by 1,000. And then you're going to multiply the millage rate. Now, in this case, and I always forget this when I go back, the millage rate was 30.85. So 30.85. And when you go ahead and calculate that, just type that in your calculator, 145,000 divided by 1,000 times 30.85. So you ended up, or you should have ended up with a tax of $4,473.25. Now, in some municipalities, that rate, 30.85, is going to be a pretty low number. In other municipalities, that might be a really high number. Again, it's very highly variable depending on where you live. But hopefully you see what's going on. Basically, the idea here is you're charged $30 for every $1,000 worth of $30.85 for every $1,000 worth of value. So another way to put it there, your taxable value was 145,000. So what we needed to do was take that 145,000 and multiply it by 30.85. Or excuse me, that 145,000, make it 145 and multiply it by 30.85. Okay, you're charging $30.85 for every $1,000 worth of taxable value. So that's how you calculate that. Again, it's a pretty straightforward, easy calculation if you know your millage rate offhand, and if you know that, then it goes real quick. So I want you to push pause on the video and try this one on your own. All right, hopefully you went ahead and did that. If you haven't yet, do so, because I'm gonna do this. So in this example, we had 265,000 was the taxable value. And we're going to divide that by 1,000 always. And then we're going to multiply by, in this case, it was 10.85, I believe. Before I move on, I'm going to double check that. So 265,000, 10.85, good. So when you type that in, this person only has to pay $10.85 per $1,000. And that means not only are they paying less per $1,000, but this person actually paid less than the first person in total amount. So this person only had to pay $2,875.25. Notice this person had an extra $120,000 worth of house. Their house was $120,000 more expensive, but still paid less in taxes because of the differences in these millage rates. And you might think that's a drastic example, but this happens a lot. Depending on where you live, you could pay really, really high millage rates, or you can pay fairly low millage rates. And again, it's highly dependent upon the city, the municipality that you live. All right, let's do another example. I want you to push pause and try this one on your own. All right. So in this example, the house was worth $185,000. Well, at least taxable value was $185,000. We want to divide by 1,000. We want to multiply that by, in this case, 15.8 or 15.80. And we get a we get a tax bill, a property tax bill that is $2,923. Okay, so hopefully you got that on your own. And so that's basically the calculation wise of how property taxes work. Now, obviously, there's more details and I'm skipping over a lot of things. Where I live, there's something called summer taxes and winter taxes. And so they give you two bills during the year. One is, again, in the summer and one is in the winter, obviously. And so those two bills um, add up to your total taxable thing, or your total amount of taxes you have to pay. And they're different sizes and yeah, lots of this, lots of intricate stuff that I could get into, but I think at least we know how to calculate and we know the main idea of what a property tax is and then what a millage rate is. So if you want to reduce property taxes, well, there's two ways to do that. One is to move to a location with a lower millage or a lower tax rate. So, and again, a lot of times, if you move 10 minutes away, it can make a huge difference on your millage. All right. Where I live in Mount Pleasant compared to where some people live who are just outside of Mount Pleasant, there's a huge difference in tax rates. Also, the other thing you could do is you could get your house assessed at a lower value. And this is not too complicated, but the cities usually have to assess your house. And so they come, they look at it, and they give a number to it, a taxable value to it. And you can actually go to the city and argue that during special times and possibly convince them that your house is not worth quite as much as they think it's worth. So you can lower your assessed value um, by arguing with the city at special times. So that's basically the only two ways to reduce your property taxes: move somewhere different or get your house assessed at a lower value. All right. So that ends this section, and that also ends the entirety of chapter 1.